Hi, good afternoon. Welcome. You're watching MF Corner. I'm Sumera Aarti. On the show today, we're going to be answering some of the queries which have been sent in by our viewers. And joining me to do that today is Anubhav Srivastava of Infinity Alternatives and Prableen Bajpai of FinFix Research. So thank you very much to both of you. And okay, the next query comes in from Nainital from Mr. L.M. Khanna. And he's asking a query on senior citizen. And since we were talking about asset allocation, he asks what should be the current equity to debt allocation for senior citizens. Prableen, does it really matter if it is now or then or any other time? I mean, is it more individual specific rather than the environment specific?
Right, Sumera, first of all, prayers for everyone, and I hope you're all out of it soon. It's a very important question because, Sumera, the right asset allocation can actually, enable the achievement of the desired results from any portfolio. Now, having said that, as you said, there is no specific ratio or a very fixed percentage that can be just directly applied. So it has to be on a case-to-case basis. Of course, broadly speaking, we often say that 100 minus a person's age is what should be allocated towards equities. And this is based on the premise that at a younger age, your risk-taking ability is higher and your investment horizon is higher as well. So for somebody, let's say 60 years of age, can actually have an allocation of up to 35% in equities. Now, again, this formula just cannot be applied in isolation, and it has to be backed by 4 other very important factors, which are number 1, your investment objective. What is the investment objective of that particular investment or the overall portfolio? Second is the time horizon. For how long is the person investing? In this case, Mr. Khanna is, as he mentions, he is a senior citizen. So is he investing for himself? Is he investing for the next generation? Factors like these will be important. What is the risk appetite? And most importantly, the need for regular cash flows, Sumera, because a lot of people in the age group of 60 and above, during your retirement years, are actually, investing in a way so that they're able to generate some regular income. So only based on these factors, one can actually decide the right asset allocation for a person. Once that broader structure of asset allocation is created, then comes the market conditions. Because let's say we've had a bull run or we've seen the markets run up, the equity component in the portfolio would have exceeded from where it originally was. So some profit booking can be done so that it goes back to its original percentage. Likewise, when markets are down, some allocations towards equities can be done. But it's easier said than done, Sumera, but at least a broader asset allocation along, after considering all these factors must be followed. And I think that is the way to have a healthy portfolio. And of course, not to miss that at his age, as a senior citizen, I think, and in the times that we are, a contingency fund should be much bigger than, how much originally I think people have been keeping.
Okay, so basically the unanimous opinion, and not just of the 3 of us who are talking, but pretty much everybody who you speak to who's in the advisory business will tell you that asset allocation is really the very foundation of people's portfolios and the journey of wealth creation. It is not time dependent, it is not situation dependent. It's the cornerstone itself, right? So you start with asset allocation and stick to it and rebalance as and when required. And of course, the one thing that must be added, if it has not already been added, is that everybody must have a contingency fund, and if required, look at scaling up your contingency. Next query comes in from Kastur Prahlad. He's written in from Pune, and he says, I'm looking to increase my large cap allocation, and therefore would you recommend investing in an NFO that's ongoing, which is the SBI Nifty Next 50 Index Fund? Prableen?
Right, Sumera. So I'll answer this in 2 parts. Now, investing in the Nifty Next 50 Index via Index Fund is a very good strategy to increase one's large cap allocation, because it's a simple, cost-effective medium to invest in the large cap space or across market caps actually. However, on the question of whether he should be investing in the NFO, I would say no. And the reason is because while investing in an index fund, we are actually looking at returns which should mirror the underlying index. In this case, the Nifty Next 50. But there is often a difference between the returns which this scheme gives and those of the index. And this difference between the returns of the scheme and the index is called the tracking error. So, Sumera, when selecting, an index fund, I think looking at the tracking error, that's one of the most important criteria. So instead of looking at an NFO, because there would be no data available for that particular scheme, there are about 6 other schemes which are index funds, offering exposure to this Nifty Next 50. So I think out of those 6 index funds, he can choose one of the funds on the basis of the tracking errors that I have calculated for the last 1 year. The UTI indexed fund for the Nifty Next 50 has the lowest tracking error, followed by LNT and DSP. So I feel that he must look at the tracking error and based on that, kind of decide which fund to go for. And overall, because he's also looking to increase his large cap allocation, Nifty Next 50 can be complemented with Nifty 50 going forward or an active mutual fund. But I think that decision he'll have to take after analyzing the other schemes in his portfolio.
Okay, well put, Prableen. Mira Emerging Blue Chip, can you restart?
Again, Asmira, I'll answer in 3 parts. Yes, the first answer is yes, okay. Why not? Time to restart. Because I think you also said that it's the right time or not. So Mira Emerging Blue Chip, it's one of the most consistent performers from the fund house, and it's seen huge inflows. And in November of 2020, the AMC actually has put down certain restrictions on the amount now which can be invested into the scheme. So as an investor, I can now only invest a maximum of 2,500 a month. That's it. There are no switches or systematic transfer plans which can be used as a medium to invest into the scheme. But yes, it's a good scheme, so he can restart. Secondly, he also mentions that it's the right time or not. So a bit on that, Sumera, because see, SIPs actually work on the principle of rupee cost averaging, which help us tide over this problem of timing the markets. And one thing which he must remember here, that investing in SIPs during the downturns is very important. Staying invested when markets are down, because that is the time when you're actually able to get, the units at a lesser price, so the number of units that you accumulate is more. And the reason why he had stopped the SIP has been a bit of a cash crunch, which he mentions. And just a bit of an advice here, Sumera, that I think the current economic and social scenario that we all are currently dealing with, I feel that, and I'm sure that he has probably already managed that, but a contingency fund, again, up to 1 year of your expenses, which includes EMIs, which includes insurance premiums, investments amount, must be kept aside. And in addition to that, some amount to cater to any medical emergency, because I think we are in very uncertain times, must be kept, and I think then only he should restart. And if all of this is in place, then definitely he must restart his investments.
Okay.